normalization. And as we stand, it seems to me that the market may be underestimating the Fed's intention. So the first chart here shows the dollar trade weighted index since the second half of 2014, since June 30th. It appreciated 24% to its peak on Jan 20th this year. And the main catalyst for that was the ECB in September 2014, indicating its intention to depreciate the euro. Now, at the time, the global policymakers were happy to acquiesce with that, and as they had been previously with the Bank of Japan, in order to assist these two giant economic areas to combat deflationary pressures. But by late 2015, certainly, dollar strength had become a problem, and it became a problem in two ways. Firstly, a commodity bear market, the roots of which were not related to dollar strength, but was in full flow, and really from late 2014 when energy started to come off, and dollar strength and the commodity bear market served to reinforce one another. You can see there the strong inverse correlation. And most significantly in energy markets, and the direct effect that this had on emerging markets and commodity producers. So commodities down, emerging markets down. Substantial and abrupt deterioration in the terms of trade for commodity exporters, commodity producers. So this put EM under major pressure. So that was the first way in which dollar strength became a problem. And the second way was related to China. So because of the peg, dollar strength dragged the renminbi higher. So here's the renminbi trade weighted index, which increased 15% between over the same period to its peak early in August last year. And with Chinese growth slowing in the way it has been, this was the last thing China needed. And China's reserves came under pressure. It was forced to spend more to defend the peg than it was accumulating through its current account surplus. So, and China reacted firstly in August last year, August the 11th, with initially a 3% appreciation against the dollar over a couple of days, and again in January, in a total of 6% from 620 to 660 or so. Now, in and of itself, that wasn't necessarily a huge problem, but the prospect of a substantial Chinese devaluation spooked global markets, and prompted mild panic, and two significant sell-offs in August and January. So, by this stage, a negative feedback loop had developed, whereby dollar strength was reinforcing the commodity and EM bear market. It was pressuring China to devalue the renminbi, the prospect of which was reinforcing, again, the commodity EM bear market. This was feeding back into developed markets and reinforcing demand for dollars in a safe haven capacity. So there was a requirement to try to break this negative feedback loop or reverse it, and it appears to me tacit but real, and it began on February the 13th in earnest when the PBOC Governor Zhu insisted there was no requirement or plan to devalue the renminbi. 2 days later, on Monday, February the 15th, Russia and Saudi agreed in principle to freeze output, and that fell through. It didn't happen, but in the context of a bombed-out energy market, it was sufficient to prompt a short covering rally in crude oil from that date, and it hasn't seen those lows or near them anytime since. February 27th, Shanghai G20, solemn agreement not to devalue, not to engage in currency wars. March the 10th, the ECB engaged in aggressive policy actions, but specified that Mario Draghi specified in the press conference that these actions weren't designed to depreciate the euro, which was something he hadn't done prior to that. So that was a change. Later that month, then the FOMC was dovish, cited international risks and the strong dollar as issues for the U.S. economy, and Janet Yellen reinforced that message on the 29th in the speech in New York. So that served to reverse the feedback loops, at least in the short term. Softer dollar allowed commodity VM, energy to recover, ease the pressure on China, and allowed a recovery in developed markets. So risk assets and oil, the bottom coincided to the day virtually with ZOO on Feb 13th and Saudi-Russia meeting. You can see the recovery there. So the consequent stabilization of international risks and easing of financial conditions now allows the Fed room to recommence policy normalization. And you can see the Goldman Sachs U.S. Financial Conditions Index there, and the extent to which that's eased, and the extent how closely correlated it has been with the dollar, and the extent to which the dollar was responsible for the tightening of financial conditions. So it's now back to levels it was at in December, the Financial Conditions Index, that is, at which time the Fed hiked. So they have room now to recommence policy normalization. And they have begun preparing the markets for that in the last 10 days with a very notable shift in rhetoric. And that's centered around the minutes of the April 27th, 28th meeting, which were released on May the 18th. You can see that the quote from that, and the second half of the last sentence, then it likely would be appropriate for the committee to increase the target range for the Fed funds rate in June. Now that's as explicit as the Fed gets, in my experience. And before and since then, there's a selection of comments there from Fed members, all of which are non-voters, it should be said, apart from Dudley. But Harker could easily see 2-3 hikes in 2016. Lacker comfortable with 4 hikes in 2016, and Dudley definitely a live meeting. Pricing of Fed hike odds way too low prior to the minutes. And Janet Yellen is due to give a speech on June 6th, which was only scheduled about 10 days ago, and she's very likely to reinforce this message then. So as a consequence, expectations have adjusted to a degree. So right now there's a 34% probability of a 25 basis point increase on June the 4th, in June, versus a 4% probability priced in as recently as May 16th. It's probably slightly lower now, just today. So expectations have adjusted, but are still low, certainly beyond June. And I should say there's a 44% probability priced in of a hike in July. This chart shows the probability that Fed funds target will be 50 to 75 after the December FOMC, and you can see that that's barely budged. So one hike is priced in. The Fed funds futures curve, we look at December 16, 0.65. If the target was 0.5 to 0.75, you'd expect that to be 0.625. So one hike is priced in, and that's not consistent with the Fed's current tone. And I think, personally, I think they're more likely to go in June than July. Possibly, partly because they specifically mentioned June in the April minutes, and also a couple of members have kind of downplayed the Brexit vote on June 23rd. So I think they're more likely to go in June, but they'll certainly go in either June or July, absent a significant deterioration in data between now and then. So once they do that, what then? Well, I think it's important to say that the catalyst for the August and Jan sell-off, the Chinese devaluation threat and collapsing energy prices are off the table now, and they're unlikely to re-emerge with anything like the same force. Now, other shocks may emerge. Brexit's the most obvious one, but in their absence, and assuming that post the Fed hike, financial conditions do not tighten aggressively, and that means that the dollar doesn't take off to the upside, and that equities, risk assets broadly hold in. But then the Fed will be free to do what they are signaling that they want to do, which is to normalize policy gradually, but with purpose. That's the message they're giving us, and it's recent, and it's a recent shift in rhetoric. But my feeling is that the markets has been a little bit slow to react to the change in rhetoric in the last 10 days. So now, in the context of that, if those assumptions are not met, if the dollar does take off to the upside and equities were to sell off aggressively, the Fed would dial back, and you know, that would change the outlook. But on the basis that those things do happen, I think that the Fed can. I think it's clear that the Fed wants to be more aggressive than it's priced in. So, what does that mean for markets? Well, there are 4 charts here, one from each of the sectors we trade. The first 2 are interest rates, which is the most obvious one. That's their 2-year yields going back 10 years or so. And you know, I expect that U.S. yields are going to rise over the next, between now and the end of the year. And you know, possibly a more substantial rise than we've seen certainly in the last couple of years. And now the dollar is important, and it's certainly likely to be supported, but only in the range, I think. Major dollar strength, a renewal of the uptrend, will be resisted by policymakers, including the Fed. So, so I don't expect a whole lot in FX. I don't expect FX to do a great deal. But at the beginning of this month, the dollar looked like it was going to break to the downside. It reversed notably on May the 3rd, big reversal days against a range of currencies, and it's continued to rally since then. So I think it will continue to be supported, but I think I don't see a renewal of the uptrend or anything like the strength that we saw over the year and a half from mid-June 14 to the end of 2015. Precious metals, which has been the most profitable sector for us this year, primarily since February, but I think they're less interesting now that the dollar's recovered and the Fed and Fed rhetoric has become more assertive. So yeah, they could they could drift for a while, possibly, and drift a little lower. And finally, equities. You know, they're important to the outlook. This chart shows the S&P earnings yield, which is the inverse of the PE, relative to U.S. 10-year yields over the last 50 years. And you know, it's at a macro level, it's just supportive of equities. Valuations are high, but I think they should be high given where interest rates are. So, you know, equity is still attractive relative to the alternatives. That doesn't mean they can't fall, you know, whatever, a few percent. But I think that chart suggests to me that the equities have a good chance of holding in response to Fed rate hikes. So to conclude, what I think since late 2014, you know, there's been a lot of, certainly back then, and again at the start of this year, there was expectation that central bank policy divergence would present a lot of opportunity, and but that's been undermined primarily by the sell-off in energy and the deflationary pressures, forcing the Fed to back away from the rate hikes that they intended, that they had signaled at even the beginning of last year and again at the beginning of this year. But this time may be different, and we may now see, it's possible, and there's not enough evidence yet, but it's possible that the prospect of central bank divergence is about to reemerge, could reemerge over the second half of this year, and you know, in a more meaningful way than it has, and you know, create opportunities for macro managers that they have hoped for over the last 18 months, but haven't really panned out. So with that, thanks for your attention, and I'll hand back to Fergal.
Okay, thanks very much for that, Conor. I hope you all found that interesting and thought-provoking. Now we come to the Q&A section of the webinar. I remind you once again to type any question you may have in the chat section at the bottom right-hand corner of the screen. We'll try to get through as many questions as we can. Okay, the first question, Conor, how likely are the Bank of Japan to intervene to stop the yen's advance?
Well, I would say not very likely unless the yen appreciates substantially from here, you know, I suppose below 100 perhaps. I don't think, well, they don't have the international support to do it. And it runs counter to a coordinated effort to constrain the dollar. So, and I think that's been made clear to them, you know, certainly by Jacob Lew, and it makes sense that it should, because Japan accounts for perhaps 2% of global growth, whereas China accounts for perhaps 35% of global growth. So China's concerns are much more significant than Japan's. So, you know, and China's interest is to constrain the dollar. So Japan is a casualty, I would say, or has been a casualty of the effort to constrain the dollar since February, and they just have to take it. So I don't think they're likely to intervene, certainly north of $100 yen. That said, I think the worst may be over for dollar yen from the Bank of Japan's point of view, or from Japan's point of view, and certainly the change in rhetoric from the Fed in the last 10 days is supportive of it, and the improved outlook for risk assets in support of it. So I think dollar yen can recover from here, you know, perhaps towards 115 over the next, you know, over the period ahead, over the summer.
Okay, thanks, Conor. And our next question, will the Brexit vote in June have any impact on the Fed's ability to act as required?
Well, it's been suggested that there's little risk for the Fed in waiting to July until Brexit's out of the way. But I suppose a couple of Fed members have said in the last week that it's not the vote itself isn't necessarily something that would get in their way if the vote was to leave the EU and there were consequences and you know there was settled global markets. Well, then the Fed, I think, would obviously react in response to that. But the vote, the fact that the vote June 23rd, I don't think it's that significant for them.
Okay, thanks, Conor. How much did the dollar bull trend over the last year or so contribute to your performance? Without that trend, with metals just drifting, with energy likely doing the same and equity supported, where are you looking for opportunities in this quarter and next?
Without that trend, with equity, with metals drifting, with energy likely doing the same and equity supported, where are you looking for opportunities in the quarter? Well, I think most obviously the opportunities in the short term are interest rate markets on the short side. Yeah, so we're positioned that way, and right now I think you could easily see euro dollars for, say, December 16 euro dollars priced in another 25 basis points. So the short side of interest rate markets, I think, is the most appealing place right now.
Okay, thanks for that. What has changed globally that makes Conor believe that the dollar won't appreciate aggressively and that risk assets, oil, equities, etc., won't resume their sell-off once the Fed begins tightening again. Is it sentiment, technicals, or have other central banks changed their goals?
Well, I think there's, as I said, a tacit effort to constrain the dollar. So if the dollar were to appreciate aggressively, the Fed would back off. And I think that's the main thing. And I mean, in terms of risk assets, oil and equities, the catalyst for the sell-off in risk assets in August and Jan, as I see it, were the threat of a Chinese devaluation, which I think is off the table now, and the collapse in energy prices. Now, I think both those catalysts are, the threat from those is much reduced. So, yeah, so they could reemerge. That's not to say energy prices can't come off again. They can easily, but I think they've bottomed. I don't think we'll see sub $30 in oil again. I think that's unlikely. So those threats are, I just don't think are there in the way that they were 6 months ago. Now, other things can emerge for sure, but there's a kind of self-regulating aspect to it. If the dollar were to take off, the Fed would back off.
Okay, thank you. Given this morning's background, how will this macro environment play into Three Rocks trading in the second half of 2016?
Well, I would say, I think that the main opportunity, the most obvious opportunity now is the short side of interest rate markets. Like I said in response to the question about the yen, I think the worst may be over for dollar yen, and that it can recover slightly. So that's the way I'm thinking now. I mean, I'm very, I try to maintain an open mind about these things and look for, the market to lead me in the right direction. So, everything is subject to change, and it's important to be, adaptable. But right now, that's what I'm thinking. Short side of interest rate markets being the driver for the over the period ahead, certainly between now and the payroll June 3rd, Janet Yellen June 6th, and the Fed on June 15th.
Okay. What risks do you see in continued weakness in U.S. earnings relative to your thesis?
Well, I think, say, like that chart that's on the screen, valuations are high, and for a good reason. I think earnings, I think our PEs could continue to rise, and equities would still be, not overly expensive if yields stay low. In terms of is the S&P going to rally 10%? No, I'm not convinced of that. I suspect it just mightn't do a great deal. Now, if the dollar stabilizes as it has, energy stabilizes, one would expect earnings to start to see a couple of positive quarters. And I'm not convinced that earnings are going to continue to decline.
Okay. Gold has advanced strongly into late April, along with a weaker path for the dollar index. Since the start of the year, CFTC non-commercial positions have moved to record net long, open interest growing to multi-year highs, and Soros and others have become vocal for bullish positioning. Do you think modest dollar strength, along with a renewed Fed normalization, will cause a major gold sell-off as weak players exit their long positions?
I'm not very strongly opinionated. I mean, I think gold to the upside, I've kind of lost interest in. But in the way that I think energy has bottomed, I think commodities have bottomed. So I think gold is, may just not do very much. The next $50 maybe to the downside. But I don't see the potential for really huge directional moves in precious metals, over the period ahead.
Okay, thank you. And the final one, does this macro environment have any sort of precedent, or is it more of a one-off?
Well, I mean, every environment is different. I mean, obviously, the central bank activity the last few years doesn't have a precedent. So it is a one-off in that sense. And the process of normalization, and which the Fed are now starting, and the other central banks are still going the other way. That's all new. But I think every situation is different anyway. So I suppose it doesn't really have a precedent, but that's not necessarily that unusual either.
Okay, thanks, Conor. And thanks once again to everyone for taking the time to tune in to us today. We will be sending out a copy of the presentation and a link to the video over the next 24 hours. If you have any questions on today or have any feedback on the webinar or any queries on TreeRock in general, please feel free to contact me or our CEO, Kieran Kane. Thanks again, and we wish our friends in the US a nice Memorial Day weekend. Thank you.